I don't know what's happening, guys, but I can't even open my X account anymore without seeing someone making fun of Berkshire Hathaway, making fun of Greg Abel, making fun of Warren Buffett, making fun of the fact that Berkshire has underperformed the S&P by 44% every single day, day in and day out. Someone is judging and making fun of Berkshire Hathaway, especially after the recent 13F filings. There were a lot of people that were confused. Although I believe a lot of the arguments make sense and it sounded confusing, but I'm going to talk about it a little bit more as I believe Berkshire is undervalued and I own a position in the company and I have other options on the company as well. And I told you guys I like buying stocks on bad sentiment, and I see Berkshire's sentiment really, really bad. And to me, it's making me very, very excited about the company. Now, this is the main counter argument against what Berkshire did. The first one is they sold United Health at a loss before the major recovery. So that was really bad timing. They also dumped Amazon, which was not a good move. They bought back Delta Airlines, which they sold at a loss, and Warren Buffett previously said that he's not a big fan of the airline business because airline business are like commodities, so you're not getting a wide mode company. They don't have any pricing power. It's all based on supply and demand, and if fuel prices increase, it kills the margin. So he said the airline business is terrible. He owns them, he sold them at a loss, then he's back in Delta Airlines, so that makes no sense. He bought Macy's. Macy's to me also looks like a value trap. It's not trading below asset value, and a lot of the assets are overhyped and overinflated by intangibles and book value and just goodwill in general, which Macy's goodwill isn't worth what is being put up on their books. So a lot of it is inflated. It's declining in revenues. It looks like a value trap to me. So that makes no sense. And they also bought Google when it had its strongest rally and when it was overvalued. So if you look at all those decisions, none of them make any sense. But to Berkshire's defense, with Google as an example, they had a position before. They were already up on the position. They averaged up 200% on the stock. Now, we don't know when they bought Google. We don't know the exact time. We don't know the exact day. We don't know anything. We just know they bought it in the first 3 months of the year. So if they bought it in March, an example, in mid-March, they made about 36% in 2 months on the Google purchase alone. Maybe they bought the bottom. Maybe they bought it in February. Or maybe they bought it in early January. So we don't have the exact details for us to really judge the Google purchase. But in terms of the other decisions, if you look at what Berkshire has done, they pretty much trimmed or sold a lot of stocks 100%. 100% of Domino's Pizza, 100% of United Health, 100% of MasterCard and Visa, which was surprising to me. But they sold a lot of stock, pretty much all 100%. And that has confused a lot of people. Now, the first thing is Greg Abel mentioned that he has a few stocks in the portfolio that he called his core holdings, which is mainly Coca-Cola, American Express, Apple, then the Japanese trading houses, and maybe Google is also turning into an anchor or into you could say, a favorite stock of Greg Abel. And he wants to take a leaner approach, a more concentrated approach. I don't know about you, but I like the company getting more and more concentrated. The stock portfolio right now looks much better. They still have a lot of tiny positions, but as relative to the size of the portfolio, over $200 billion, the portfolio is looking leaner. It's looking more concentrated. In my opinion, it's looking much, much better than how it did before. But you also have to remember that many of those stocks were likely owned by Todd Combs. Todd Combs was a manager at Berkshire Hathaway, and he recently left to join JP Morgan. He was managing a sum of money. We don't know which stocks he exactly owned, but the rumors were that once he leaves, they're going to liquidate his portfolio. So maybe he had a separate account, and in this account there was Amazon and there was a lot of things. They didn't transfer the shares. They just shut down the portfolio, and it shows that they sold 100%. But maybe in April they bought back some of them in the core portfolio. But again, we don't really know that. So it's really hard to judge those decisions because you have Todd leaving. I think in the next quarter, we're going to have much more clarity. But the Google decision, for example, even if they bought it in February, so far it has been a good purchase. And I don't know about you guys, but I would rather them buying Google around 24 PE, 25 PE than sitting even more in cash. So I don't think it was really the worst purchase in the world. And we're going to see what happens in the next 13F if maybe they just liquidated the portfolio and then they bought back those stocks in early April in the main portfolio. And we don't know that yet because it ends in March. So we're going to find out in the next quarter. But there's a lot of positive things going for Berkshire. There are a lot of people are not paying attention to. The first one is the CPI increasing in a major way. Now the CPI is about 3.8%. There's over a 32% chance of a potential rate hike this year in 2026. This is a massive change, and inflation is ramping up. Do you know who benefits from higher inflation and mainly higher interest rates? It's mainly companies with a lot of cash, or mainly insurance companies. Why? Because insurance companies are sitting on what they call the float. This is the claims that are coming in, the premium that's coming in every single month, and they don't have to pay it out until years and years later. So it's pretty much like a 0% interest rate loan. They take it and they put it in the treasuries. If the Fed raises interest rates, the treasury yield is higher. They get a higher return for just sitting on this cash and doing nothing. This is how Warren Buffett and Berkshire has boosted their returns in a major way over the last few years. If you look at the insurance business, the underwriting segment has actually done really well year over year. A massive growth, about $300 million, or almost actually $400 million. But the investment income at the insurance business has declined by about $200 million. The main reason for the decline was due to lower interest rates. They also have the dividends. The dividends have been stable so far, but the interest income from the treasuries declined 10%. Now, I don't think they're going to raise interest rates, but if the CPI remains high and they raise interest rates, Berkshire is one of the best hedges against higher interest rates, because they can reinvest the cash in the T-bills at a higher rate than where they have them right now and earn much better returns. And again, if the higher rates cause the market to go down, Berkshire is sitting at $370 billion in cash, and the market knows it, and they can be able to buy a lot of stocks for cheap. So this is one of the best hedged stocks, you could say, in the market. And I like this setup very much. Now, some of the arguments on my last video were around the buybacks. And I said that Berkshire Hathaway and Warren Buffett and Greg Abel, they don't buy back stock just for the sake of buying back stock or just to reinstate confidence. They buy back the stock if they truly believe the stock is below intrinsic value. They believed it was, so they launched the buyback program. Now, I got the arguments that they only bought 431,000 shares. That's not a lot of shares, which means they just did it to show some confidence in the change of leadership. While this could be true, again, I don't believe Buffett and Greg Abel have done that, but you have to take a few things into consideration. Yes, they only bought 431,000 shares, but they announced the buyback program on March 5th of 2026. The annual meeting was on May 2nd. So there was a 2 month period. Now, normally before an earnings release, before an annual meeting, you have something called a lockup period where the company can't really buy back much stock. It's normally 2 to 4 weeks. So if you want to give it 4 weeks, for example, as a lockup period before the annual meeting, they only had 4 or 5 weeks, like a month and a half, for them to execute the buyback program. So the way I think about it is they didn't buy 431,000 shares in the quarter. They bought 431,000 shares within 4 weeks or 3 weeks, pretty much. So it's not really the worst deal in the world. And I think they will likely be buying even more over the upcoming quarters as the lockup period is now over. But you have to take in the lockup period into consideration before saying that the company just did it for the sake of doing it, because it's only 431,000 shares, while it was mainly because of the lockup period and the timing of the announcement of the buyback program. Now, if you look at the valuation of Berkshire, it's trading at 1.4 times book value per share. That doesn't really look too low on paper, but I read something very interesting in the annual meeting, and this is the fact that Berkshire hasn't really repriced the railroads. They haven't repriced a lot of the assets that they own based on how much they're worth at the moment. So it's still based on their initial cost basis on their book. So the book value of 1.4 times is based on their initial cost basis of the railroad BNSF when they bought it, I think in 2012 or 2015. They still based on when they bought Geico years and years ago, when they bought a lot of things years and years ago. They haven't really been repriced to the current date. So the book value is even higher than where it is right now because of that. And this is what they said. They said you can take book value because we have everything at a historical cost basis and try to adjust our various companies that a BNSF is recorded on our books at the original price we bought it. at versus what it's valued at today. So if you really want to dig into the book value, you have to look at the railroad and try to value it based on today and add it to the book. But if we just take the book on face value based on historical cost basis, it's trading at 1.4 times tangible book, which I believe is very, very cheap. Now, in terms of how much we're paying for Berkshire today, we're paying $488 per share. You're getting $184 in just cash and T-bills. The equity portfolio pre-tax is worth $134 per share. You're left with about $186 per share of operating businesses. So those are like Sears Candies, Railroad, and even the insurance business, and all the operating businesses not in stock, just operating business. Okay, those operating businesses, they generate $16.07 per year in operating earnings. Based on the operating earnings, we're paying about an 11 PE for Berkshire Hathaway. 11 PE, and you're getting the cash, and you're getting the stock portfolio, and you're getting the culture where you're not going to get diluted, no major stock-based compensation, no kind of convertible debt or anything crazy. For me, I think the stock is undervalued. It's really undervalued, and I like it very much. I still like the setup, especially if you own a lot of tech or a lot of growth stocks. I think that could be a good hedge against higher interest rates or just around the market pullback in general. And that's my opinion on Berkshire Hathaway. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.